Hey everyone, welcome back. In today's episode of Portfolio Analysis, we're going to investigate the beloved technology portfolio. However, instead of cheerleading its amazing returns and recommending an ETF portfolio, instead, I'm going to make a case against heavily weighting your portfolio to technology. So if you're interested in hearing a contrarian perspective on the NASDAQ in 2021, then stick around because I'm sure you're going to love what I've got for you today. According to Guru Focus, graphics microchip producer NVIDIA is currently selling for $610 per share, but it has a fair market value of only $290. Even with a modest 8% discount rate, the margin of safety here is negative 110%. Please remember, if you enjoyed this video or any of my research on YouTube or the website, please let me know by subscribing, liking the video, and writing a comment. Several viewers have asked me why the NASDAQ ETF QQQ was not part of my 2020 portfolio challenge. How can you run a portfolio challenge and leave out the NASDAQ, the best performing index of the last decade? Well, that's certainly a fair question. So instead of doing my usual portfolio breakdown this week, I thought it might be interesting to lay out my logic behind omitting the triple Qs from last year's challenge. In this segment, I'm going to try to make a bear case for the NASDAQ. But please keep in mind, I personally love technology and the tech sector, and I have a small portion of my own portfolio, something like $30,000, invested in the tech sector as I'm recording this. First, let's look at the returns of the NASDAQ, because they have been just off the charts over the last decade. For example, the QQQ ETF has returned an average annual return of over 20% every year since 2011. 20% is an astronomically high rate of return. It's so abnormal, in fact, that it's historically significant. A $100,000 IRA account in 2011 has grown to $650,000 in just 10 years' time. Keep in mind that this is a fixed account. This is where an investor never adds a single dollar of additional money into this portfolio. They simply deposited the $100,000 and then walked away for a decade. This return is so substantial that it's more than 3x the return of a traditional 60-40 pension. The pension fund returned a respectable 10% average annual return, but still got trounced by the NASDAQ index over this time. Just to give you an idea of how significant an annual 20% return really is, if we took this same $100,000 IRA account and left it alone for 30 years instead of just 10, and we continue to receive that 20% annual return on our initial $100,000, we end up with a balance of over $24 million. Maybe a 20% return doesn't seem that spectacular over the course of a single year, or maybe even a couple of years, but when you compound it over a span of time, you immediately understand just how remarkable it really is. At this point, we all know how well the NASDAQ Technology Index has performed. So the question we need to ask ourselves is this: what do we think the probability is that this index will continue to produce these abnormally high rates of return? Obviously, nobody knows the future, so there's no way for us to know for certain, but we can make an educated guess. The NASDAQ index is market cap weighted. The top 9 holdings represent 52% of the 100 companies in the index. The top 9 companies are Apple, Microsoft, Amazon, Tesla, Facebook, Google, NVIDIA, PayPal, and Adobe. At the time I'm recording this, There are only 4 companies in the world with a market capitalization larger than $1 trillion, and all 4 of those companies are in this index: Apple, Microsoft, Amazon, and Google. Facebook is closing in quickly with a market cap of $850 billion, and then there's Tesla right behind that with $650 billion. Under normal circumstances, I don't really give much credit to the price to earnings ratio. But when PE values reach levels of extreme, it could and should act as a warning signal. The PE is the price to earnings, and it tells us basically how much each dollar of profit is worth to investors. For example, Tesla has a PE of 1,173, which means that investors are willing to pay $1,173 for every single dollar of revenue that Tesla produces. Amazon has an 80 PE, Nvidia has an 89 PE, PayPal has a 75 PE, etc. For comparison, Microsoft was trading at a 74 times multiple, in other words, a PE ratio of 74, at the height of the dot-com bubble, and financial historians often point back to that specific metric to illustrate the exuberance of the time. Now, I'm not saying that the 2021 NASDAQ is in any way in the same shape as the 1999 NASDAQ. In 1999, the combined NASDAQ PE ratio was over 200, whereas today, in 2021, the NASDAQ PE is 45. So, at this point, we know the market caps and price-to-earnings ratios are off the chart. Based on this, we can assume that the individual companies contained in the index are probably not value stocks by any means. There are plenty of value models that you can apply to companies to try to determine their intrinsic value, and in the interest of time, we're just going to apply the discounted cash flow or DCF model to a few of these companies, just so we can visualize in our mind any potential value or lack thereof. All of these top 10 companies are fairly similar in terms of their estimated market value and intrinsic value. According to Guru Focus, graphics microchip producer Nvidia is currently selling for $610 per share, but it has a fair market value of only $290. Even with a modest 8% discount rate, the margin of safety here is negative 110%. If we want a second opinion and we head over to simplywallstreet.com and pull that company's analytics, we can see that their DCF value for Nvidia is at $241 per share, 153% less than its current market price of $610. Okay, so we know the market caps, the PE ratios, and the intrinsic valuation models are all suggesting that these companies are substantially overpriced. If we look at the weekly chart for the QQQ ETF, going back to 2008, we can see that the triple Qs has gained about 1,500%. And in the last 12 months alone, it's gained a staggering 110%. Does any of that mean that there's a crash coming? No, not at all. But for due diligence, we should at least take a look back in time and see what's happened in the past.
Gotta get back to the past.
If we rewind the chart back to 1999, it's a very different story. From 1999 through 2009, we see a max drawdown of about 84%. Consider for a moment those technology investors who watched a $1 million portfolio drop to just $160,000 over this time span. So, if you were one of the viewers who reached out to me to ask why I didn't include the triple Qs in the 2020 challenge, then this video is for you. First of all, I really felt like it was cheating. The NASDAQ has done so well for so long that everybody already knows that it's going to perform the best. One of my primary objectives when I created this channel was to advocate for responsible, long-term investing strategies. The NASDAQ had a great decade, but we can't overlook the fact that the prior decade it lost 84% of its value. In contrast, portfolios I feature on this site in this series, such as the permanent portfolio or the all-weather portfolio, they have never lost more than 8% of their value ever. Also, keep in mind that we don't determine which portfolios are best simply based on their returns alone. For us here, winning portfolios are ones with the highest return and the lowest standard deviation, as measured by the Sharpe ratio or the Sortino ratio. And keep in mind, I have included the NASDAQ in the 2021 challenge, which is currently underway. I've mixed the triple Qs with the China Qs just for diversity's sake. So if you're interested in hearing more about how that challenge is going, stay tuned because I've got another video coming up shortly that will cover that.
GameStop. Hedge funds, they're gonna lose billions.